Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 262nd podcast VideoCast for the week ending October 24th, 2024. Family first, then we'll get down to business. Thanks for joining us. This is Mimi with Maggie Steffens training over in California. Annabelle is number one for her age in the nation. Oh, excuse me, that's Annabelle. And that's Mimi. Annabelle's number one for her age in the nation for backstroke again for the fourth year in a row. And Mimi is crushing it in water polo and is loving training with USA Women's Water Polo Olympic captain Maggie Steffens. So really proud of both of them. And this was Annabelle's results. Came in number one for 100 back this past weekend. And there are my new Vans, ladies and gentlemen. VF Corp, here we go. These are super cool. They're the same ones as the old ones that I had in white and green. Now these are in all green. I think they put out cool stuff, but what do I know? Moving along, so that's the existing ones. Those are the new ones. For those of you who are new to the podcast, this is related to a holding we have called VF Corp with Bracken Darrell, which is a turnaround. They call me Turnaround Tom for the new folks out there. And he's turning that company around just like he did with Logitech, which was a 26 bagger after he came in after the stock was down 82%. The same thing came in with the stock down more than 80%, starting to turn it around already, ran up to $20, consolidating, and will move higher over time. This is dinner with my buddies from Fox. That's Kenny Polcari, you all know. Michael Lee, of course. He grew up in the same town that we have our house in Connecticut. There's Mark Tepper you see every morning on Mornings with Maria and Varney as well. And I call him AJ, Adam Johnson. We had a great time at Catch Steak, which I know from as the Maritime Hotel back in the day, but they've changed over and it was delicious. Other than the fact they had no anchovies, inside joke. Then I got to go to the Al Smith dinner last week, which was absolutely so much fun. Ran into so many people and just an incredible time. That was Donald Trump telling jokes. The other candidate was a no-show, which is the first time in 40 years, I think, both candidates haven't shown up. So not an ideal situation, but turned out to be a great night. Those are some photos there. And I don't know exactly what happened, but maybe because I've been to a number of them before. That was with Cardinal Egan. I got my picture up there. I don't know where the pictures are. They took pictures. I don't know where they posted them. I haven't really Googled for them yet. But that was just a phenomenal time. So I got to sit next to Mary Higgins Clark granddaughter was at my table, and her partner. We had a really fun time, and her father, and got to meet Paul Singer from Elliott Management. He was at the table right next to me, and the vice chair of Alibaba, by the way, Mike Evans, president of Global. So I had a few nice words with him. And pitched Paul Singer on Intel, so we'll see what happens if he shows up. Look, in a handful of the positions we've put on, whether it was Crown Castle, etc., we seem to put them on, and the activists seem to come invariably. 1 or 2 months later. So maybe we'll get a partner in Intel. It certainly makes a lot of sense from my point of view. Then we had that's a little premature there. We had was on Varney and Company yesterday. Want to thank Preston Mizell, Christian Dagger, and Stu Varney for having me on. We discussed after Boeing earnings and before the vote what to do if they voted for the union package, what to do if they voted against the union package, and we did exactly what we advised after the fact, and also talked about the potential areas that will benefit if the polls are right and Trump becomes the next president. And I don't say that with any partisanship. I say that with betting odds, which we're going to talk about, and some of the internal polling data that I have access to and other things that that I have information on that seem to be pointing towards, for sure, the executive, and in some instances pointing to a sweep, which would be less good for equities, believe it or not. So we're hoping for a split government, which would probably mean a Republican executive, Republican Senate, and Democratic House. I think that's a good scenario for the markets. Obviously, anything could happen, but we just need to deal objectively with how we can make money from it and leave the emotionalism and idealism to the political pundits and people who care about that stuff. We're on this podcast, and you're on this podcast to make money, not to make political viewpoints. So with that said, let's get back to money. Here we go.
We're going to open the market in about 12, 13 minutes. Some red ink today, down 250 on the Dow, down 94 on the NASDAQ. Tom Hayes back with us this morning. Rising interest rates, that's what's hurting the market. Tell me, why are rates rising like they are?
Well, I think the Treasury market is starting to price in pro-growth, pro-business policies, and that implies that maybe the Fed won't have to cut quite as much.
Pro-growth, pro-business policies?
You bet.
That's a Trump presidency.
That's a Trump presidency for sure.
And the Treasury market's reacting to that? You're 424 on the 10-year now.
Yeah, no question about it. There's another factor. So other people would say, the skeptics would say, oh, there's going to be deficit spending. But actually, during the last Trump administration, the 10-year yield was between 1.30 and 3.20. So that old dog don't hunt as far as that argument goes. The other thing to keep in mind is seasonally over the last 10 years, October happens to be the worst month of the year for bonds. November is the best month of the year for bonds. So you want to sell the rumor, buy the news. After the election, you want to be buying bonds.
If you think Trump's going to win the election, what should you be buying on the stock market right now?
Well, this is a controversial one. First off, Boeing, okay? They just reported they missed earnings this morning. This was a kitchen sink quarter for the new CEO. He came from Rockwell Collins. Under his tenure, the stock over a decade went up 4x. This guy's going to turn around the company. They have the union vote today. Here's my suggestion. If the union votes against the pay package, i.e. the strike continues, wait till it drops 5%, buy some Boeing stock. If they vote yes, the stock's going to go up, buy some stock. Industrials are going to do well. Defense spending is going to do well. This is a stock that did exceptionally well. So industrials, small caps did exceptionally well under Trump. Emerging markets did exceptionally well. Consumer discretionary did exceptionally well. I'll tell you what didn't do well that everyone thinks is the Trump trade is energy stocks. Energy stocks did not do well under Trump because there was a lot of supply. Prices were low. Margins were less for energy companies.
That's fascinating. Good stuff. Tom Hayes, thanks for joining us. We'll see you again soon.
Thanks for having me.
All right, the campaign.
And we're back. On to the next. And then this morning, I was in lovely Connecticut, and, at like 11:20 a.m., I got an email, can you be on at 12? So after a very quick shave and a very quick put the suit on and very quick put my studio in order, I was happy to do so, and I got a chance to talk about the Boeing vote and the union and the implications and Tesla and a whole lot more. So we're going to listen. First off, I want to thank Jenna DeTomasis for thinking of me and having me on the show.
So again, this tale of two worlds, we want to pursue this a little bit more. We got Chama Hyder here of Zen Media, the CEO there. Thomas Hayes back with us, the chairman and managing partner, Great Hill Capital. Thomas, on Boeing, if you'll indulge me a little bit on this, this idea that workers reject a 35% pay hike. Now, the devil's in the details. I'm not aware of all the details. That's a big pay hike to turn down. I'm just wondering if you're a corporate boss anywhere else, let's say of the large union workforce, does that get you nervous?
Yeah, Neil, I think the IMA, the Union for Boeing Workers, may be overplaying their hand here. So far, they're paying the workers $250 a week to strike. These are six-figure jobs. They've already gone through about $41 million. They only have $300 million total. And Boeing workers are only 6% of the union. So basically, you've seen a situation where they've eroded 13% of the union's assets, 530,000 members, in just a handful of weeks. Within 31.5 weeks, they will be down to $0 of assets. They started at 300, they're down to 260. Boeing, on the other hand, can tap the public markets anytime they want and raise 10 billion, 20 billion, and wait this thing out for 10 months, 20 months if need be. And I think from an investor standpoint, Neil, we just have to step back. They've got a $500 billion backlog over the next 10 years. They've got to deliver thousands of planes, 6,200 plane backlog. So Boeing's going to be just fine. Look, we were in the market adding to our position like crazy this morning. We did think 35% was extremely generous. Boeing started at 25%. The union wanted 40%. Boeing came up to 35%. They're rejecting. I think some of these workers are going to find themselves as part of the next 17,000 worker cut that Boeing recently announced they had to do, and they may be overplaying. They're looking for a 40% raise, but they may get a 100% pay reduction.
Yeah, we forget about that 10% of the workforce, 17,000, you're pointing, who are going to lose their jobs, and more could happen after this. We'll see how that plays out. Shaman, now back to the better story of the day, and that is Tesla. The stock is soaring about 20%. It surprised a lot of folks on the upside and put the Magnificent back in the Magnificent 7, I guess, but not all of them are going along for the ride. What do you make of the significance of what Tesla reported?
I'm thrilled, Neil, and I will tell you, I am bullish on both Boeing and Tesla, going through very different challenges, but they've got very interesting leaders at the helm, so I look at that. And one of my fun hacks is to actually look at LinkedIn and see what employees are saying, and you can really see the energy in Tesla employees. They shipped their 7 millionth vehicle recently, and so I think it's to be expected. I do not bet against Elon Musk. I think he knows what he's doing, and you can just see how excited the people are. And so much of this does come down to people and vibes.
If I'm Elon Musk, I'm excited too, because I'm the world's richest human being. I'd be happy and dancing on stages myself. But leaving that aside, Thomas, I'm curious about Tesla. What is remarkable here is that the government guarantees and checks you get to buy an EV, they've shrunk considerably. And so a lot of those Tesla sales are what they call naked sales. In other words, without any benefits or any, government incentives here. What do you make of that?
Well, speaking of naked, Neil, the naked short sellers got hammered this morning, that's for sure, in the Tesla stock.
Point.
So you never want to bet against Elon Musk. I think that's the idea of a government subsidy. They want to promote a specific ideology, a specific method, a specific technology. So they have to subsidize it because it's uneconomic in the nascent years. And now that it's gaining mainstream adoption, it is getting a leg of its own. You don't see it across all the car manufacturers. I've always been skeptical. I've said, I'm not sure people want EVs, but I do think they want Teslas. There's something special about Tesla when it comes to EVs, and I think that's going to continue as he rolls out refreshed models, more affordable models for the masses. I think he's got legs.
Let me pursue that with you, Shaman, and what it might say about technology, because one thing that's been beneath the surface is we used to have those 7 tech stocks. I'll throw Tesla into that camp. It's more than an automaker. And all the others in the S&P 500. Now it's the S&P 493 that are doing quite well, as are the tech stocks. So how do you play that going forward?
Yeah, I think, listen, and I apologize for anyone who gets this song stuck in their head, but it's like, the grease is a word, it's a feeling. That's AI, right? That's automation. That song's been playing in my head all day, but that's really what we're seeing. And so I'm really bullish. I mean, I'm bullish on, we haven't even seen this, but Meta and, just look at all the things that it takes to power that AI, right? So you're talking semiconductors, you're talking supply chain, you're talking manufacturing. I'm very excited. I think this year ends really on a high note.
Shama, I'm old enough to remember that song. There's no way in heck that you can be. Or Tom, that guy in the box next to you. But we'll see, because, grease and just buying tech is the word. Guys, thank you both very much. Do appreciate it. Again, we'll follow this disparate direction on these 2 key stocks. But I thought we'd zero in on these folks because maybe that is emblematic of this market. There are the gainers and there are the losers. Robert Kiyosaki says the stocks themselves are getting a little pricey at these levels here.
As well as Neil Cavuto. So here we go. And we're back. And then finally on Sunday night, I got to be on Bloomberg Radio, Bloomberg Asia with Doug Kisner again. Thanks to Doug and Juan Torres for having me on. Here, we talked a lot about different implications of the election, but more than that, we got to talk about Asia, China, and Alibaba. Here we go.
Joining us now is Thomas Hayes. He is the chairman at Great Hill Capital, joining us from here in New York City. Tom, thanks for making time to chat with us. You and I were talking a little while ago about the fact that there seems to be powerful momentum right now happening for the U.S. equity market. I think the S&P 500 closed Friday at yet another record. We have seen 6 straight weeks of gains. Is this a little concerning to you?
A little bit, particularly because of the seasonality, Doug. So this is the 7th time in the last decade the S&P has been up 6 weeks in a row, and it's basically a coin flip based on history, whether we get a 7th up week this week, about 50-50. So we'll see what happens. But I think what you're seeing here, Doug, is a combination of complacency plus liquidity. Most central bank cuts in the month of September that we've seen since 2020, and prior to that, 2009. And then you couple that with, if you look at betting odds, if you place any weight on betting odds, potentially the market may be pricing in a shift to slightly more pro-business policy. Whether premature or not, it seems to be telling the story, particularly when the market's going up and our earnings came in a little bit lighter than expected so far.
So stocks are up, yields are down by and large, and we had Raphael Bostic saying at the end of last week he's not in a rush to lower interest rates. Do you think the Fed may be a little concerned here? Put aside for the moment the labor market, put aside for a moment this decline that we have seen in the rate of inflation. Is the Fed perhaps a little concerned about easy financial conditions?
Well, they have shifted to a dual-sided risk, and the labor market, as low as the unemployment rate is, it is showing some signs of weakness. Now, are we guaranteed getting 6 consecutive cuts in a row? The market's been a little bit too optimistic, so I'm not sure if November is a foregone conclusion. I think the market's pricing in 225 basis point cuts, but maybe we only get 1. I think that's perfectly fine given the current conditions. The other thing that I've really had my eye on, Doug, is last month we got a record move out of bonds, a 2 standard deviation move out of bonds. And you got to look back all the way to 2001 to 2003 to see that level of move. And if you remember, and I think you were around back then, Doug, you had an unprecedented rally following that in small caps versus large caps, in value versus growth, and in emerging markets versus developed markets. 3 trades that very few people are confidently positioned for right now.
I want to change gears, talk a little bit about the other side of the world, the Asia Pacific. In the week ahead, markets in Asia are gearing up for what is likely to be the busiest week of new listings in more than 2 years. Particularly, it's China, it's India, it's Japan. What does it say to you that developing markets are in the process of raising a lot more capital?
Yeah, the game is back on. Animal spirits are coming in. The Chinese government has flipped on the dime. Yes, investors want more. Yes, investors are skeptical after a 2-year beatdown. And yes, they are going to get more because why? Because you can't be half pregnant. They've already turned the corner. They're going full bore. They will do more, and then they will do more, and then they will do more. And the Chinese government, the game is back on. We're going to see more fiscal stimulus coupled with the monetary stimulus, coupled with backstopping the property market. And when that happens, massive flows. And I think, and you mentioned Japan there, some of these emerging markets that have been the beneficiary of emerging market flows out of China, like Japan, like India, that have gotten a little bit heated, I think we're going to see a little bit of weakness in those markets as money slowly and more confidently over time moves back into China, particularly the most high quality companies in China. And the IPO market, the slate that you mentioned, tells you everything you need to know about confidence recovering and starting to rebuild.
So are you a buyer of risk assets in China right now?
Yes. One of our largest positions is Alibaba. This has been like watching paint dry. It's been dead money for us for a year. We spent every red day buying more stock. People looked at us like we had three heads. But here's the fact, Doug. You can buy Alibaba today for the same price it was 10 years ago. The only difference is the revenues are up 1,300% and the earnings and cash flow are up 650%. So what else do you want to talk about? I mean, we see it as one of the greatest. Price is what you pay, value is what you get. And in terms of the cash generated, they generate $20 to $25 billion a year in cash. They got $80 billion of cash on the balance sheet. They've got a piece of basically every AI startup in China. They give them credits for compute power in their cloud business in exchange for equity. I mean, if you wanted to play an AI ETF in China, it's called Alibaba, and that's got zero credit in the price right now. Couple that with AI, with the cloud, and with the consumer coming back with the fiscal stimulus, it's the toll gate for China. So we like that position, and we love the valuation at high single digits, down from historic multiples of 20, 25 times, and they'll come back over time.
Let's talk about the U.S. presidential election. We're a little more than 2 weeks away from November 5th. Obviously, it's a critical day, or will be. How are you feeling about the election, and what would Trump presidency mean versus Harris presidency for the business environment in the U.S.?
Yeah, it seems like the market is starting to price in slightly more pro-business policy, which implies a Trump win. That's evidenced in the data, in some of the polling data, and certainly in some of the betting data, in some of the betting pools that you look at. It's starting to favor a Trump win. I think betting on the basis of who's elected is a fool's errand. If you recall, when Trump got elected, everyone said China stocks were going to do horribly. From 2016 to 2018, China stocks did better than they've done in years. And then when Biden was in, they thought China was going to do great. It did horribly, the worst it's done in a decade. Furthermore, everyone said when Trump would get elected, energy stocks would go to the moon. The exact opposite happened. When you have more drilling, the price goes down, and the stocks went down with it. A lot of supply was not good for energy stocks under Trump. So I think that what the ideal outcome from a stock market standpoint, Doug, is just a split government. So whether Trump is elected or Harris is elected in the executive branch, so long as you have a different party in either the House or the Senate, the market loves gridlock, and empirically, the market does best with a split government. So that's what I think we want to be focused on as market participants in the next few weeks.
Okay, so if you're reading the data properly, or at least these indicators that you're looking at right now, and there is a higher probability of a Trump administration, do you really believe that additional tariffs are pro-business?
Well, look, I've seen some studies on the impact if Trump actually put forth the 60% tariffs on China. The data that I've looked at implies that that would only reduce Chinese GDP by 1%. So we would potentially, in the short term, bear the brunt of the higher prices. However, as some of his selected potential Treasury secretaries and trade negotiators in his formative administration have implied, that is the ask. It is open to negotiation. And Trump has said as much. We just want to do a deal. So he'll hit them hard, bring them back to the table, and try to get a pragmatic outcome. As we saw in the early part of the administration from prior to COVID, that he did have some success in doing that. And the subsequent administration actually followed through and kept the tariffs he put in place active during the Biden administration. So I think it's more of a let's get to the table, but first I'm going to bop you, and then I'm going to hand you an ice pack to help heal together and make something that works for both parties. And I think we'll see a pragmatic move after the initial shock factor.
All right, we'll leave it there. Tom, thank you so much. Thomas Hayes is chairman at Great Hill Capital, joining us here on the Daybreak Asia podcast.
Thank you, Doug.
Thomas, thank you.
And we're back. And then finally want to thank Chibuke Ogu and Amanda Cooper for including me in their article on the markets and the Trump trade and what will work if in fact the polls are correct and the betting odds are correct. Also want to remind you, I will be speaking in Sarasota, Florida on December 5th through 7th at the Money Show. Just go to hedgefundtips.com. You can register right here at this link. Scroll down until you find it. It's either on page 1 or 2, or you can just go to the search bar here and type in Money Show and it will come up and you can get registered. Next is quotes of the week. First one from Buffett. Someone's sitting in the shade today because someone planted a tree a long time ago. That's the name of the game in proper investing, is the correct framework with patience. And his partner, Charlie, says it's waiting that helps you as an investor. And a lot of people just can't stand to wait. And that's what I try to impart on this weekly podcast. And I think many of you have learned from it and many of you have benefited from it. I know that many of you have benefited from you because half of you come to me each quarter and say, I made XYZ $1 million listening to your podcast. Now I want you to manage it because I got a business to run. And speaking of which, I want to congratulate all the people who got in under the wire and got in their applications, requests, and are now getting approved and funded at Interactive Brokers for our final raise of the year, fourth quarter, which we closed out. RJ, Nate, Paul, Rick R, Ryan, Jake, Damian, Marlon, Andrew, Mike S, Joe, Javier and Luis, Mike T, Stephen M, and Micah. Congratulations all for coming in Q4, and we acknowledged all the existing clients that have been with us since the beginning last week, so grateful to everyone, and just the beginning. Finally, quote of the week is Peter Lynch. Your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. And that's the name of the game with all the different noise and political and geopolitical and yada, yada, yada. At the end of the day, is the cash flow going up? Are the sales going up? Is the turnaround plan kicking in gear? And if you got all those things and you enter at a reasonable price, good things happen to quality companies over time. And now moving in, this mug reminds me from my friends in Dallas who I get to see next week when they're through New York, and then going back to Dallas with them to watch the Cowboys game in early November in their box. So very excited for that. Which reminds me of opinion, not advice. As always, we don't know your financial situation. We deal exclusively with accredited investors and qualified institutions. So talk to your financial advisor before doing anything. Go to hedgefundtips.com, click on trades. Opinion, not advice. Here we go. The current high level of market concentration suggests the equal weight S&P will outperform the aggregate index by an annualized 8 percentage points over the next decade. What does that imply? Well, if the heaviest weights and the heaviest earnings in the rearview mirror have been the Mag 7, and these cycles are correct, which we believe they are, and by the way, this points to exactly what? Again, 2001, 2002 to 2007, same exact situation, where what outperforms small caps, emerging markets, industrials, financials, value over growth, and so on. And that's where we want to be, and that's where we are, and that's where we're positioned. And we had a fun day in the market buying Boeing this morning, buying some reloading on the long-dated BABA options. We never touched a single share, and we didn't add shares because our basis is so much lower because of all the beautiful opportunities that Xi Jinping gave us over the last 12 months. So we don't buy up, but we were able to reload on all the options that we took off at huge profits on the initial spike. And this is the scenario. Notice no one is talking about David Tepper. They were all talking about David Tepper when they were tripping over themselves to buy Alibaba at 118. Now at 95, 96, 97, 98, no one wants it. Everyone forgets he said, God willing, we get a pullback, I'm going to load up again and break my position limits again. because they'll do more and do more and do more, which I reiterated on Doug Kisner's show on Bloomberg over the weekend. So there it is. This is probably the most important chart you can understand for the next 7 to 9 years. This will be our guiding light for that period, and we are positioned to take advantage. Current aggregate valuation metrics, you see the S&P 500 22 times. Where is value? Energy, some energy 13 times, financials 16, communication services, then healthcare, there's some opportunities, and so on. There we go, another chart that's telling us the same thing, equal weight outperform, which means Mag 7 should underperform, which has been the case since the summer when we took off our Amazon and most of our, all of our Google, etc. So there may be opportunities to reload on some of those, but there have been plenty of other things to do. Earnings actually coming down in the last week, so we're keeping an eye on this. What does that imply? With the heaviest weights being Mag 7, that's a reasonable amount coming out of Mag 7. It may be a temporary slowdown, but you have to keep an eye on this. If you're index overweighted and not buying discrete companies, you're going to get hit the worst. And the opportunity to make many doubles under the surface is riper than it's ever been. And we're excited to have gotten everyone to take advantage of some of the things that have happened in the last few days and may happen in the coming few days before the election. And we'll be very excited for that. It's like, it's basically like everyone who came in fall of 2022 and then March of 2023. I mean, it was just Christmas time, and I think the same exact thing is happening right now. And you're seeing it in your accounts with the work that we're doing on a daily basis to get you guys well positioned, and it's super exciting. And it's got to be super exciting for you, for all the names that you see coming in that we haven't even begun to talk about yet. So this is S&P earnings growth, shows the green line. Remember, this was negative last quarter, the unmagnificent 493. And 2 quarters ago, this blue line, which was the Magnificent 7, was at 50%. Now it's at mid-teens, and the other one is ramping up. And next quarter, Q4, is going to be the first coming out party for the unmagnificent 493 to hit double-digit earnings growth, baby. We've been talking about it, and here we go. So we are positioned for sunshine. 28 times Magnificent 7 earnings multiple versus 18 times equal weight. That's where we find the opportunity to make moolah. Buyback authorizations have surged 21% year to date. I don't love that, ladies and gentlemen. That's the one thing I like about the Chinese that I can't stand about the American CEOs is the Chinese CEOs buy stock like crazy when their stock has been decimated and they know the intrinsic value. The American CEOs buy stock when it's at all-time highs so they can dump their shares out in the market and absorb them with shareholders' money. I do not like that, and I won't participate in it when I see that. I'll leave it to the retail people to be sopping up that excess supply from the CEOs dumping on their head. CEO confidence has rebounded in recent quarters. These are the type of things you see at recoveries at the beginning of bull cycles, not at the end. You can look back to early 1990s after the recession. You had CEO recovery. 2001 to 2002, again, over and over every single week. If you guys learn that, you're going to make fortunes. That's just how it works. 2009, same story. And here we go, ladies and gentlemen, just coming off the mat, which means more investment, more excitement. Where do you get price is what you pay, value is what you get? Where do you get the most value for a dollar? Well, it's not the U.S. You can see the multiples here. It's not Japan. Europe is where you start to see value. Emerging markets, big value. United Kingdom, bigger value. Biggest value, China, which, by the way, did better than anything else under Trump, not under Biden. So everyone thinking Trump with his 60% bluster, tariffs, talk, it's nonsense. He wants to cut a deal, and he will cut a deal, and then he'll let China alone. And that's exactly what the world needs. Mutual cooperation, but no one taking advantage of the other party, and everyone wins. So average small business credit card utilization rates have surpassed 2019 levels and are approaching a decade level high. So that's good credit expansion. Forward PEs, you can see between Magnificent 7, followed by, that's the pink line, then orange. I know a lot of you guys love to listen to this podcast while you run or bike or golf. If you can view it, you get more value by seeing the charts, but if you can only listen, maybe look at it later, that's great too. I want to give you guys as much value as I possibly can in hopefully the shortest amount of time possible, although there's just too much to cover. Forward PE ratios. This is the U.S. value at 17.2 versus the all country world index ex-U.S. is at 13.6. So there's a lot of value available around the world if you know how to seek it out, and that's what we do day in and day out. Corporate insiders are cashing out. Right here you can see selling is pretty high near the 2021 early 2021 levels. The market did rally till the end of 2021, so that's also something to keep in mind on a lagged basis. Corporate margins are near all-time highs and are not yet showing signs of letting up. So this is a positive thing. Unemployment rate we covered. Retail sales post solid gain in September, showing a continued strong economy. The beneficiaries were miscellaneous store retailers. Remember, consumer discretionary pounding the table. Clothing and clothing accessories. Let's hope VF Corp falls into that bucket. And Goose. Health and personal care. Food services and drinking places. I still haven't found a restaurant yet. Got my eye on Cracker Barrel. Probably not going to do anything with that. Food and beverages. And what did poorly? Gas stations, furniture, electronics, and appliances. Philadelphia Fed Manufacturing Index going up. Manufacturing new orders going up. Remember, we've been in a Great Depression for manufacturing for 2+ years. It's starting to recover. That's the next phase of the recovery. And emerging markets currencies outperform when global trade recovers. And global trade has been recovering, and it's just the beginning for emerging market currencies, despite the short-term counter-trend rally in U.S. dollar and in Treasury yields. We're going to talk a lot about that as we go forward. On to home builder sentiment starting to tick up. China, 1-year prime loan rate collapsing. They continue to cut rates, which is fantastic. China cuts benchmark lending rates as easing push to boost economy continues. China industrial production is now ticking up. Actually, GDP came in slightly better than expected at 4.6% for the quarter. Industrial production absolutely skyrocketing off the mat in China. Industrial production, you can see. PIMCO says private credit is overvalued as complacency spreads. You think? That's said with utmost sarcasm. Sentiment is optimistic but not euphoric. You know, it is that time of year when you should get some chop, and we finally saw some this week. But I do think if the pro-business, pro-growth policy candidate continues to poll and bet well in the betting markets, people are going to be very nervous to sell too much stock ahead of that. If it's super close is where I think you're going to see a little bit of trepidation going into the election and a little bit of choppiness. But if it is as runaway as it appears right now, which again, I think is way too early to draw any conclusions, but the trend is your friend, it's going to be really hard to see these dips not get bought. So what did we have here? Okay, so we had the biggest inflow followed by the biggest outflow. So that's the retail people getting chopped up. If you remember when BABA was at 117, 118, we said now they've got to beat the stuffing out of these late Johnny-come-latelys who wouldn't buy it in the 60s with us. Now they're tripping over themselves to get it at 117, 118. Sold to you on the options. We kept the stock. And now in the high 90s, we've been adding back long-dated options and option spreads like it's going out of style. And same thing, Boeing. I mean, my fingers are, we're busy when my 10 key reads for Thursday gets posted on Twitter at 8 p.m. at night, and I start the podcast at 8:30. So I've been busier than a one-armed paper hanger. Let's put it that way. All right. Private clients bought munis, dividends, and utility ETFs just in time for yields to blow out this week. So there you go. The bull and bear indicator is stretched, but it's not at an extreme yet, which is why we keep muddling higher. Profits matter more than politics. At the end of the day, the earnings growth was the key, as we all know. And we've got on the low end, 13% earnings growth expectations for 2025. It's between 13 to 15. It's probably come down to 14, but we have not seen guidance from the major companies yet. So let's not hold our breath. Let's see what happens. And, well, not the base case. Tax cut. Oh, yeah. If the Tax Cut and Jobs Act expires, would represent the largest tax rise in history. I think that's what the market's a little bit relieved about, which is why you've seen a consistent rally throughout September and October in anticipation of good things happening. And maybe that not expiring, maybe that getting extended would be a very positive thing. Consumer sectors have fared better under Republicans, so that would be consumer discretionary, consumer staples. Net international migration has rebounded sharply following the end of the pandemic, you think. But actually, if you go back, it's kind of interesting because the last time we had this spike in net international immigration was when? 2001, 2002, which sets the stage for all the good things that we're talking about in the areas that we're positioned. Consumer industrial stocks sectors are the most labor intensive. Consumer discretionary industrials, that would work. Those would do exceptionally well under the Trump trade. If you remember, in the Trump administration, the average people did a lot better than the people with assets. And since the pandemic, basically, if you had assets, i.e. real estate and or equities, you made a fortune. And if you didn't, you got smoked because you were forced to pay taxation, material taxation without representation in the form of inflation. Inflation is a tax on the poor brought to you by your government policymakers when they want to run inflation hot because they want to spend without collecting revenues. And that's exactly what's taken place. So in the administration before the current administration, what we started to see was massive wage growth among the working class, and people were getting ahead, and that would be consistent with industrials, consumer discretionary, etc., versus only the white collar sectors of tech making all the money, financial services, etc. China has accelerated purchasing semi-manufacturing equipment since the semi-export ban in 2022 to develop its own capacity, and they're succeeding. So a lot of this front-loaded stuff is now going to be felt by those companies that looked to be impenetrable and that everyone chased the shiny objects. So we'll see how that plays out in coming quarters. Estimated stimulus is just a fraction of total CapEx. So we see the CapEx estimates moving forward. This game is just beginning. That's going to accelerate. That's going to be helpful for earnings. You also have the reshoring trend and manufacturing, depending on the administration that gets in a handful of, it's a couple handfuls of days. 10 years of underinvestment in U.S. manufacturing. This is just getting started. So you want to take advantage of companies and sectors that will benefit from a mass recovery. That's building, that's construction, that's industrials, that's you name it, real stuff type of companies, the type of companies that boomed, small businesses like crazy. Mentions of reshoring near all-time highs. I mean, this is completely off the charts. Stuff is old. We've had basically no non-residential fixed asset spending, basically peaked in the 50s, collapsed in the late 70s, early 90s, and is just started to recover. So there's going to be a lot of CapEx and spend in fixed assets. Small cap sales growth highly correlated with capex growth. So as this recovers and manufacturing recovers, what does best? Small caps, which we're excited about, much more so than large caps. Historical guide to the election. Okay, presidential election year. So the year before the election is the best. The election year is second best. The year after the election is just fine. And then the midterm years are the worst. So keep that in mind. Democratic presidential split. So this is a bunch of, year after the election, post-World War II, market saw stronger returns when the same party remained in control. Well, we'll see if that happens. It's not pointing to that right now, so we'll keep an eye open to it. In election years, small caps typically sell off in October, which happened, and then rally in November, December. That not only happens in election years where small caps rally like crazy in November and December, that happens in every year. If you look at Cooper Standard stock, it has its biggest moves oftentimes in November and December, along with small caps. And yes, we were in the market buying more CPS. In election years, that doesn't mean you should. I'm just telling you that's what we were doing. Opinion, not advice. In election years, small caps typically underperform large caps and outperform the following the election through year end. Look at this chart with small caps in November and December, October week, November, December through the roof. Very exciting times. So far, so good with a 5% earnings beat led by financials. That they're talking about earnings season so far. Easing rate pressure to translate into. By the way, they're talking about falling interest rate, mortgage rates. That's not happening yet. This is a counter trend rally. I'm telling you that right now. That we're going to talk about. October is the worst month of the year for bonds. November is the best month. So, as we talked about with Stuart Varney, sell the rumor, selling bonds October, buy the news in November. Yields will compress, mortgage rates will go back down. Improving sentiment suggests reaccelerating EPS growth in Q4 in line with consensus. So this was a trough Q3, kind of lame-o earnings, followed by Q4, should be back up to big-time growth. Positive reactions to beats, most positive reactions to beats since second quarter of 2012. So that has not been the case up till now, and now people are getting optimistic when companies beat. They really drive them up, so that's really good. And not only have beats outperformed, but misses haven't gone down as much, which is consistent with a bull market. This is from Bank of America. A tax hike to 28% from 21% is expected to be a 5% hit to EPS. That's the Harris administration proposal, so that would imply the S&P goes down. A tax cut to 15% from 21% could be an estimated 4% benefit to S&P 500 EPS. I would bet zero on that happening, but you never know if you get a sweep, which I wouldn't bet on either. But I don't know. People that are much smarter in politics than I am seem awfully confident, but I would not make any major economic decisions on the basis of that speculation. Geographical sales exposure. This shows that North American-based companies still have 71% exposure in the U.S., and then 29% in the rest of the world. European companies have only 21% in the U.S., Japanese 15%, and Asian countries are getting all, which makes sense, but actually it's nice to see it color-coded. Here we go. An investment year in 2025 looks priced. The recent discount to S&P PE multiple reflects concerns over Park's over-earning and a lack of conviction in long-term streaming profits. So what they're saying here is the Disney premium versus discount to the S&P 500 forward PE ratio. And the one thing you'll notice is in those rare instances when Disney was trading at such a multiple discount to the S&P, preceded monster all-star rallies in Disney. We love Disney. We own Disney. We buy Disney. We visit Disney. We everything Disney. So happy Disney. We expect a re-acceleration of experiences. And by the way, I mean, talk about the most nonsense announcement that they made. They made a few announcements this week. Number one, they're going to let you cut the line. I guess they have another way to cut the line without getting the special one-on-one tours. So basically, they're going to collect more revenues doing that. They're raising the annual ticket prices. And they announced that they're going to announce sometime in 26 who they're going to announce as the successor to Bob Iger, which means you can take the mantle of leadership from his cold, dead hands because he's not going anywhere. He realized that the minute you retire and you get in the back of the car, there's no one in the front to hit the gas. So, and your phone stops ringing. So he decided, I'm going to hang on to this until death. So that's not a horrible thing. Iger will be fine until eventually they push him out. But for now, it's great. We expect a reacceleration of experiences, operating income growth in fiscal year 2026 as part of cruise ship startup costs flip to profits. So you can see parks including cruises, total experiences, just super duper reacceleration out to fiscal year 2026, 2027, 2028 off the charts. And then you see operating income from Disney's entertainment assets saw meaningful earnings growth in fiscal year 2024, led by falling streaming losses. So they went break even on streaming, and all of a sudden the operating income is booming, and no one's giving them any credit. As a matter of fact, the stock right now is just basically priced for the experiences and the products, and you get all the entertainment for free, including ESPN, Disney, the movies, the Hulu, et cetera, et cetera, et cetera. And yet, when you look out a couple years, you see $19 billion of operating income that has zero value ascribed to it. So what else do you want to talk about? This is price is what you pay, value is what you get. Quote, we see improving DTC profitability as the primary driver of entertainment growth ahead. This is from Morgan Stanley, by the way. Now that streaming has reached profitability, Disney is focused on managing down. Okay, so that's that. U.S. government bond yield, another counter-trend rally. We will show you the seasonality behind that. Dollar counter-trend rally. We will show you the seasonality behind that. Corporate sentiment indicators tracking at a record level so far this earnings season. What is that consistent with? It's consistent with the beginning of recoveries, not the tops. And you could see here in 2011, and if you look back to the early 2000s, was a similar story. Chinese consumers will respond to incentives. What you saw was incentives in household appliances recently. And what did you see? Sales of household appliances went through the roof. Expect to see more of that in retail, and with Alibaba as the toll taker of the retail business in China, to quote my friend in Dubai, who I'm going to go out and see sometime in Q1. They'll take advantage. Car sales in China in September were the highest for 2024. So that's that. What do we have here? This is... the major events coming up in the next few weeks. You have October payrolls in the first Friday of... that would be not first Friday of November for October. That's before the next FOMC meeting, so that's going to be a critical volatility day, first Friday of November. Then you have the U.S. elections. Then you have the FOMC. Then you have October CPI. And then you have NVIDIA earnings the third week of November. So a lot of big volatility days. And as you can see here, breadth continues to broaden. The advanced decline line for the S&P 500 skyrocketing, mid-cap skyrocketing, small-cap skyrocketing. This is a good thing. And overall margins are at highs. Next 12-month profit margin, 13.6%, highest ever. That is unbelievable. Insiders are selling into the strength, as we talked about. So I'd be cognizant where that is rampant and stay away. And we've talked about that in many past weeks. The combined property losses from Helene and Milton are likely amongst the top 10 hurricanes since World War II. We haven't seen anything like that since 2017 with Harvey and Maria. Okay, I guess Harvey and Maria. And if you recall, we covered a few weeks ago, there was a total loss of 623,000 cars, total loss, which led to the highest SAR of the cycle, which led to a $146 stock price for Cooper Standard on $7.19 of earnings. So this is not at that levels of Ian, but it's close. I think we're going to see a decent amount of car loss. And you saw the GM earnings. They had a big amount of pull forward in U.S. truck production in the most recent quarter. So that bodes well for Cooper Standard. It's all about volume. And this could be a contributing factor to help into a year-end rally with small caps, which would potentially make this one of the most incredible situations that we could think of. So buybacks, corporate clients hit record highs in June, well above trend. Rolling 4-week average trends by market cap. Large cap inflows since April are up. Mid caps have been down. Small caps have been up the past 3 weeks. We covered large caps. Mid caps are just turning up now recently. Small cap inflows since June have been pretty solid. U.S. financial conditions turning up. 5-year inflation break-evens are back to 2.2 and change. It looks like 2.25. So that's pretty good. That's inflation expectations, which the Fed watched very closely. We talked about the low valuations ex-US, which implies international, which implies what? 2002 to 2007. Who will win the presidential election? Here is Kalshi. This is one of the betting things that everyone goes to. It's showing 59 Trump, 41 Kamala. I mean, this stuff can be misleading, so don't get faked out. But the market, it feels like the market is pricing in this outcome, and we just need to be cognizant of it. Irrespective of which side you're on politically, it makes no difference. Here, we are on the side of making money by following a solid framework and being patient and playing the time arbitrage game. Non-financial corporate business net interest payment near record lows. This shows corporate balance sheets are doing great. Corporate client buybacks on track for record year. S&P companies tax rate has declined over the past several decades. You can see that here. I mean, this is really, really low. Seasonal. Okay, we're going to cover that in the article of the week. Markets are pricing in fewer Fed cuts. That is a function of good economic data. I think we're still going to get the November 25. We'll see about the December. Wouldn't surprise me either way, but a lot of things in the works now, so we'll see what happens. Eurozone consumer confidence has been going straight up. That's a good thing. U.S. beige book activity, same thing you see at every recovery. You have the first initial rally off the death knell, like we did in 2020, big rally, and then you just check back and say hello before the next move up. Very similar to the mid-85 decade off of the last steep tightening cycle we saw from 80 to 82. You had the spike, and then you had this test back, and then you had a continued recovery through the early 90s when you had a mild recession. And so this implies several more years of runway. I was talking to a friend over the... I don't remember when, but it was about, the average recession. You get a recession every 4.1 years. You have to keep in mind we have had 2 in the last 4 years, which does imply, i.e. 2022, 2 quarters of negative GDP growth. And that's what positioned us perfectly in the trough of 2022 when we were pounding the table to buy in the hole and everyone else was selling in the hole for a recession. And I continued to say, I remember it was on Charles Payne's show, everyone's preparing for a recession. We just had in the rearview mirror. We had 2 quarters of negative GDP growth in 2022. Look it up. That's a technical recession. Whether the government wanted to label it or not I could care less. What's that old thing? If it looks like it probably is. Anyway, I'll leave that to you. And then 2020. So 2020 we had a recession. 2022 we had a recession, which implies we're not due for another 8 years if you take 4 years on another 6 years if you take every 4 years on average. 2000, it would have been 2004, but we had it pulled forward in 2022. And then the next one would be 2028. So that implies at least another 4 years from here. So, latest U.S. bond sell-off echoes the one after the 1995 Fed cut. We've been making the case for a long time that this was a mid-cycle cut, just like 1995, which is why I'm in the camp that we may wind up with a higher terminal rate than everyone thinks. Everyone thinks it has to go down to 3 or 2.5 to get to inflation. I think inflation is going to run higher like we did post-World War II, 3.5, maybe 4, in a band of 2.5 to 4 to bring down debt to GDP ratio, inflate it away like we've always done. And this is very, very interesting here because so I'm going to show you what happened 2 times. Number one was 1995, the last time you had this mid-cycle cut and you saw this fake out counter trend rally in yields right after the first cut where yields rose 50 basis points. So here we are. This is the long bond. I think this is the 30-year, 1995. So you had the same collapse in bonds, spike in yields into the first cut, and then you rally higher, and then you get these checkbacks and consolidations, checkback and consolidation before moving higher in bonds, lower in yields over the ensuing years. So that's the 1995 story. But then you look here at Treasury futures put call skew, and we've covered skew on equity options for quite some time, and particularly in recent weeks, and have talked quite a lot. But skew on treasuries, i.e. purchasing options 1 and 2 standard deviations out for huge moves, has never been bigger than it is right now. And the last time it got this extended, meaning people were short treasuries, was September of 2023, when we were pounding the table to buy bonds and that yields were going to compress. And that was the peak at 5% 10-year treasury. And sure enough, there is your September 2023 with a 107 low here on this 30-year bond, and straight up rally pretty much ever since. Now a little consolidation before we make the next move higher. Here's a survey from Alpine Macro. Did you overweight buy Chinese stocks based on Beijing's latest policy changes? And the vast majority were saying yes due to a tactical upgrade. The ones who said no said they were waiting for a bigger package. And then there was a group that said yes, expecting major re-rating. We're kind of in the latter camp, expecting a major re-rating over time. Do the math, which is code for opinion follows trend. China may raise the quota on special purpose municipal bonds. We covered that in recent weeks. It'll be about $859 billion of stimulus, just shy of $1 trillion over the next 3 years. That will be more than enough. Here's another poll. Oh, that's the Kalshi poll. Then you've got Predict It. Continuing claims have pushed higher. This is a very important number to watch. If this is reflected in the jobs report the first Friday, you can be assured that in November, the 95% odds that are currently in for a 25 basis point cut will be fulfilled. Initial came down, but that's very noisy from week to week, and it was coming off an enormous spike in September. And that's that for the charts of the week. Disney World, Disneyland launched new pass to skip long lines for a hefty price. We like hefty prices as owners. $400 a day. That's really cheap compared to the tours, but good for them. Alibaba Cloud's AI technology sparks breakthrough in RNA virus discovery. So all these things that we're not getting paid for yet, which we will in the future. Intel to sell minority stake in Altera for $17 billion. Oh, I thought they were going out of business. Oh, yeah, they're selling off this tiny part of their business for $17 billion, by the way. So it's all part of a bigger turnaround plan. Amazon exec tells employees to quit if they don't want to work 5 days a week in the office. Commercial continues to come back. He made Pfizer a household name. Wall Street wants more. So you got starboard value in Pfizer now. That's going to be a heavy lift, but we keep our eyes on it. That one could be interesting. It's just there's nothing we really want to sell to put in its place, but we will continue to keep an eye on that. This shows that spending is the problem, not taxes. So if the polls and betting odds are correct, and Musk comes in and does this spending cut program, the thing about Musk is all the things that people say are impossible and can't be done, he finds a way to do it. So on that basis, if he could actually normalize spending, then we could keep tax rates low, and it would be the formula for an absolute boom, less regulation, less spending, more money in the hands of private business owners who know how to allocate much better than government bureaucrats, and continue to be off to the races. China GDP annual growth rate, again, that came in at 4.6, topping expectations of 4.5. China's home sales gain momentum as Beijing's support revives confidence. China capital inflow jumps in September as firms shift to yuan. Chinese share buybacks hit record high as Beijing steps up support. Why am I not logged in? $33 billion in buybacks so far in 2024. Here we go. Share buybacks have soared in mainland China this year. I mean, look at this stuff. Is absolutely incredible. Off the charts, and just the beginning. Literally off the chart here. We've never seen anything like it. China cuts key lending rates to support growth. Starboard reportedly takes big stake in Tylenol maker Kenvue. By the way, I met the CEO of Kenvue at the Al Smith dinner and talked to him and his lovely wife for literally a half hour before the event. These are the nicest people I've ever met. And it's funny, I went back the next morning and I looked at the stock. I said, this thing is perfect. I mean, it's great. And I just said, I'd just like it to come down a little bit lower. And sure enough, the next day, some activist came in and the stock shot up 8%. So we'll keep an eye on that one. If it comes back down quite a bit, we'd be interested in taking a look. All the staples are a little bit elevated right now, so I'd want an opportunity to buy it cheaper. But he's got a great group of brands, spun out of J&J, Tylenol, Band-Aid brand, all the consumer products from legacy J&J, which is pretty exciting. And I think he's generally doing a great job. U.S. continues to surprise to the upside. That's from Yardeni. That's the economic surprise index, which we've covered. Crisis at Boeing and Intel are a national emergency. Not only are they a national emergency, but the national government is going to backstop them. So that's why we continue to add on weakness for both of these companies. And I think they're going to be enormous opportunities. Boeing is a duopoly, which we covered a million times. And Intel, the government has no choice but to prop up their foundry business, just like they propped up Elon Musk's EV business, because it was an initiative of the U.S. government to subsidize it until it became profitable on its own, which we also covered, ironically, on Neil Cavuto today. And they will do the exact same thing to Intel until they get their foundries and can compete with Taiwan Semiconductor. And so everyone chasing all these guys who design chips, they are completely worthless without the people that make the chips, Taiwan Semiconductor and soon to be Intel. Insiders are selling into the great bull market of 2024. We covered. With steady sales, new vehicle inventory begins to look and feel normal, getting back to 2019 levels, which means what? We are going to start to get more and more incentives and more price reductions and more interest rate reductions from the Fed, and the game is going to hum for Cooper Standard. opinion. The stock market is ready for its melt up as investors ignore growing risks. Who's this from? Ed Yardeni. Okay. Intel plans to form foundry alliance with Samsung. So there are basically three major foundries in the world: Samsung, Taiwan Semiconductor, and Intel. That alliance is a good thing, not a bad thing. GM stock had its best day since 2020 after the automaker tops Wall Street's third quarter expectations and raises guidance. He talked about the pull forward in truck production, so that's all good for Cooper Standard. China's stock market could enjoy instant boost from 2 trillion yuan fund, says think tank. Says the fund would enhance the stability of the capital market and promote steady growth. So all these things are happening in the background, and all the people who bought up at 120 are puking at 95 just before it goes to 140 and beyond. Traders' enthusiasm for stocks returned to levels seen just before 10% drop last year. That's from Citibank. Always wrong, never in doubt, but certainly plausible. America is primed for a home renovation resurgence with rates coming down. That benefits Stanley Black & Decker. That benefits Generac. That benefits a lot of great companies that have been left behind. Disney is going to cost more to visit Disney World for the holidays next year. So, instead of buying the tickets, buy the stock. Fed's Daily says she doesn't see reasons to stop cutting rates. We agree. Insider selling soars to 3-year highs in the U.S. while China buybacks surge to record at lows. This is the kind of divergence. So what do we want to do? We want to buy the stock that U.S. insiders are selling. And here he has the chart of NVIDIA with all the insider sales. It's just funny. I mean, they're almost perfect. They sell at these peaks. They don't sell in the hole. They sell at the peaks to the retail. Announce stock splits. They stop selling down here. They sell at the peaks. You're going to see a ton of stock dumped on heads in the next few weeks, and on and on and on. Europe's rate cuts will lift stocks. Where to find value? The massive flooring company says the housing market will get better next year. That's from Mohawk Industries. Boeing workers reject a $23,000 pay raise. What comes next? Half of them get fired, and then the strike gets done. Tale of Two Cities, stock market and sentiment results. This shows TLT seasonality over the past 20 years. It shows that October is the worst month for bonds, meaning yields rise. November is the best month for bonds. Prices rise, yields fall. So expect to see the same thing. Okay, update regarding the union workers. Rejected the 35% pay raise and bonuses. Expect Boeing to announce another round of layoffs in the next 2 days and raise $10 billion plus of capital to starve out or wait out the union. Facts. The union head earns $330,000 a year. 33,000 Boeing strikers are getting paid $250 a week with no salaries, many of which have normally six-figure incomes. This is costing the union $8.25 million per week. The union started with $300 million of assets. It has been depleted for 5 weeks, which is 8.25 times 5 is 41 million. This implies the IMA has less than 260 million left. The problem is there are 530,000 members of the IMA union, so Boeing workers only represent 6% of this union's members, and they have already depleted 13% of the total assets in 5 weeks. If you were the other 500,000 non-Boeing members who had contributed dues for years, how comfortable would you be to see your reserves dwindling into the abyss? The only reason you contribute is so that money is there. If you go on a strike, they pay you $250 a week while you're on the strike. But if Boeing uses up all the money, you get nothing, and they get nothing. So meanwhile, the strike is costing Boeing $1 billion a month. They can raise $10 billion in a minute and wait them out for 10 months. Or if they raise $20 billion in a combination of debt and equity, wait them out for over a year and a half. By the way, for everyone worried about dilution, if they raise $20 billion of all equity tomorrow, which they wouldn't, it would only take the share count back to 2014 levels. They have repurchased billions of dollars of stock over the last decade. Meanwhile, the union cannot go raise money in the public markets at the drop of a hat. They rely on contributions from working union members, 6% of whom are not working. The union will cease to exist in 31.5 weeks, just over half of a year, as 6% of the union members from Boeing will have burned through 100% of the cash. In addition to the union being unable to compete with Boeing on a waiting game due to their inability to raise $10 billion in the public markets overnight, the workers who are not receiving salaries and getting paid $250 a week by the union are running desperately behind on their mortgages, car payments, and other bills. Many who have now rejected a 35% pay raise plus bonuses will find themselves with a 100% pay loss as the next round of 17,000 cuts is imminent. So that's the story there. Covered that. Tale of Two Cities. The themes here. Mags 493, great. Unmagnificent 493 outperformed Mag 7 with a pro-growth White House. Small caps outperform large caps. Values outperform growth. Emerging markets outperform developed markets. Money coming in out of bonds and into. So we covered this. The last time that this much money came out of bonds, October 2024, is 2 standard deviations worth, was 2002, 2001, 2002, 2003. And what happened over the next 7 years? Well, you had small caps have the biggest rally, one of their biggest rallies in history over the next few years. Emerging markets, and then China had their biggest of all time. So that's that we covered. And then seasonality, where are we? Are we here, which would be S&P seasonal composite since 1928. The bottom is in on October 27th, and then you start to rally into year end. It could be there. And this is another seasonal composite during election years where you get a little bit more weakness into the end of October and then you rally into the end of the year. Either way, this more of the story is rally into the end of the year. Fear and greed is still not at extreme greed. Neither is Association of Active Investment Managers. Retail earnings, top 30 weights. Estimate revisions in the last 60 days were down 1.7%. Transports were also down 1.62%. Estimates down for 2025 from 277 to 275. So keeping an eye on that. I think that will bounce up after we get through the middle of earnings season. We covered that. And now, okay, so now we're on to the Ask Me Anything questions. The podcast is officially over, but many of you like to stick around for the Ask Me Anything questions, which we're going to get to right now. So, this comes from Aaron L. Hey, Tom, always look forward to weekly podcast, VideoCast. Was hoping you could take a look at PBF Energy. PBF, interested to hear your thoughts. Thanks. Okay, Alan, thanks for sending that in. Let's look at PBF. Okay, so it's up 10x, but it's dropped 50% from the peak after being up 20x. Let's see. PBF. Look, I think energy is going to actually get a rally, but so revenues are down. They're just recovering cash flow. I think there are higher and better uses. It's not bad, but I wouldn't buy it here. We'll leave it at that. That's just from a lot of experience. Sam R. Thoughts on ADM stock. Archer Daniel Midland. Let's take a look. Do like exposure in ag. Probably not yet, but let's take a look. I mean, long term you're fine, but I think there are probably better entry points. Revenues are down a bit. Shrink this a little bit. Yeah, there we go. Free cash flows cut in half since 2021. Let's see. Yeah, I think it's okay. I just think it's a not yet story. It's close story, but not yet story. And I don't know if that's $20 away or $10 or $5. It's just not. It's not a fat pitch down the middle for me yet. Sagar Kanakia. Hi, Tom. Hope you're well. Was just listening to the Boeing earnings call. CFO mentioned specifically the DSS division. They expect margins to be negative. Fixed price development programs. I understand Boeing has a huge backlog. Strike will cause sufficient company profitability once it turns the ship. This thing is going to mint cash once the workers come back on. It'll take a few months to get back on to full production, but there's nothing to really think about here in my view. Paul Gertz. Hey, Tom, hope as well. Rereading some of Buffett's letters, wanted to share a quote from the 1987 letter that's relative to Alibaba. Quote, the speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price. That has certainly been the case with Alibaba and now with Boeing. So we're pretty excited about that. He says, you've preached this concept countless times, but I figured it would be a great reminder for us listeners as Alibaba takes a breather. Smart listeners have been and will continue to take advantage. Thanks again for all you've taught us, Paul Gertz. Well, thank you, Paul. That was a very nice thing to share. Ite Naman asks, can you look at Valeo? Let's see. VALEO. Valeo SE. All right, so this company does powertrain, lighting, driver assistance, thermal cameras, LiDAR, radar. I mean, LiDAR companies are a train wreck. I really would not do that. But let me just see the company's financials real quick. I mean, right now, the only people that sell EV cars effectively is Tesla, and they don't use LiDAR. They probably should, but they don't. Valeo. Let me see this. Sell systems for automakers in company systems, powertrain systems, thermal systems. Okay, so it's an auto parts supplier. Parking and driving assistance, radars, connectivity, short term, flywheels, fuel consumption, enhanced driving comfort. I think this is just a Cooper Standard story part 2. Volumes are the name of the game. Probably less operating leverage than Cooper Standard, but maybe a little healthier. Let's take a look here. It's interesting though. Their revenues have been flat since 2017, so they didn't really have that big dip and rise. So you're not going to. Let's see here. Their ROIC is mid-single digits. It's not been that great of a business. But let's take a look. Price to book, cash flow. Yeah, I mean, I think this one might be beaten down because, it's French, number one, and number two, all these auto parts suppliers have all gotten hit, just the basket. I think this one's worth doing some work on. So good work, good find, but not without risk. So now you got to do the real work and get on, a dozen or so conference calls, look at the investor presentation, establish a short thesis as to why are people short and getting out, and then what is your edge to why you should be getting in when everyone else is getting out. Vincent Sentmore, hey Tom, I know you already own Cooper Standard. Curious to hear your thoughts on Aptiv. Probably the same thing. APTV. Yeah, margin's starting to reaccelerate it. APTV. Yeah, I think that this one also warrants some work. Electrical, safety technology solution, commercial vehicle markets, signal and power solutions, engineering component products. Yeah, look, these are all going to work when Cooper works. I just think that the operating leverage per unit of dollar at risk is greatest with that one, but I think that you could have a basket of it too. Mohammed Otaibai, appreciate the podcast. I appreciate you listening. Can you please tell me your daily routine, how you get productive? Also, opinion on Occidental looks good for the next 5 years. So I don't know if that's a question or an assertion that you think it looks good for 5 years. First off, thank you for listening. And my daily routine depends on the day. Yeah, I think there are better things to do than Oxy, but people get faked out because they think Buffett's buying so much, but he's actually exercising a ton of warrants he got for debt financing when they did a big deal in 2019. He got all these warrants. They were completely worthless until 2020. And then once they got back in the money, he's been exercising it for stock before they expire. So don't mistake that to natural buying near the highs. It's a completely different story. He has a lower basis. So daily routine, I read. I mean, the first 2 hours of every day, I basically read. Then I go through all of our portfolio. Then I look for opportunity. I mean, it really just depends on the day. I exercise, do push-ups, do crunches, walk on the treadmill, watch CNBC and Fox Business, and work my ass off. That's what I like to do. So I don't have to think about getting productive. I am immediately productive. The old basics, write down a to-do list the night before, check it off during the day, read. Most important thing is reading and learning. And there you go. That is for a client that came in late. Okay, well, we're closed out for this quarter. First, thanks for a very good podcast. What are your thoughts on super microcomputer? Not interested, but I'll just take a quick look for you. Okay, so it went up 100x, and now it's fallen 60%, so everyone's excited to buy it up only 40x. This is not for me. I don't care if they make cancer cures. I'm not interested. I think we covered this one last week anyway, but thank you for the question, Anders. And welcome to the podcast. I can tell you're probably newer. And we're grateful to have you on board and hope you learn some stuff over the next couple of years. Kyle Burns, can you take a look at Moderna and let me know if you'd consider it undervalued with enough margin of safety? I look at it every 2 weeks and I continue to say no. I mean, you're betting on it should work, like Pfizer should work, but you're betting on them coming up with like a cancer vaccine, which if they do, it'll be a 100-bagger, and if they don't, it'll just languish there. So I'm not in the predicting market. We still have a big position in biotech as a basket, which we believe is going to continue to benefit from lower and lower rates over the next 2 years and go parabolic. And we're happy to participate that way in a basket. But guessing what things are going to get approved or not approved, or thinking we have a scientific edge and gambling on it, absolutely hard pass. Okay, that's another. Philippe Andrew Pinko says, do you have any book recommendations for better understanding free cash flow and solvency analysis, especially in the context of turnaround situations? Love to dive deeper, build confidence up, blah, blah, blah. Keep advocating your podcast among my circle. Thanks for sharing. All right, so first off, thank you for sharing it with your friends and your social circle. If you're getting value from this, the number one compliment you could pay is share it with 1 or 2 people you know and love, who love markets and would benefit from this information. The more people you share it with, the longer I'm going to do it for free for non-clients. And happy to continue to do that because of people like you, Philippe. Start with Security Analysis by Benjamin Graham, and then The Intelligent Investor by Benjamin Graham, and then read the CFA books if you haven't done that yet. And that'll be a good starting point. And then you need, a decade or 2 of experience also helps. Kate Howells. No. Okay. Hi, Tom. Rates continue on the decline and business cycle broadly ticks up as expected. Will REITs, as the segment reversed their downward long course, or at least stabilized? Oh, they've already stabilized if you're in the right ones. I mean, we bought Crown Castle in the 90s and it's up, got up to like 115, 120. Now I think it's 110. That's just getting started. That's another one we got into right before Paul Singer got into it at Elliott with his activist campaign. The ones you pose here are lower quality REITs, so I wouldn't be in those. We went with the high quality. We did Vornado when no one wanted it. We made a quick double. We got out. It's continued to be fine. I think that will continue to work. We're just playing it through Crown Castle. We don't need to dig down deep because you're never gonna, when you look at CIM, I think that's Chimera. You're never gonna understand what's in the portfolios of these tiny little companies with mortgage-backed securities. It's funny, we were talking about this at dinner the other night with the Fox boys. What's NLY? NLY is the best one in terms of mortgage-backed securities. They've already recovered. I really don't want to mess with WPC, MPW, and CIM. They might work as trades, but you're just kind of gambling and winning. Oh, WP Carey. All right, I'll take a look at that one for you. I think that's a higher quality one. WPC. I knew Chimera back in the day. They had really good management. I don't know if it's still the same. Net lease properties, self-storage, All right, financial analysis. Balance sheet. Cash flow. And snapshots. 5.8%. I mean, WP Carey is probably okay. MPW, what's that? A Medical Properties Trust. You got to be careful with those. I mean, you're guessing and you'll probably be right. I mean, that takes a huge amount of work to get confidence in that. I just look. REITs had their big decline, whatever it was, when we were talking about Vornado. Okay, that's when we were buyers. And what we like to do is get huge sector dislocations and then buy the highest quality companies in those. So in 2020, when energy was trading negative, we weren't buying Carrizo Oil and Gas. We were buying ExxonMobil in the 20s. We were buying the best companies, Chevron, Occidental, that type of stuff in the 20s. Vornado, buying in the hole. I mean, I remember you guys, like, buying in at 18, buying again at 12, and then it just shot from 15 to 30 overnight and took a double, and sure enough, it keeps going. But, you know, you got to book some gains every now and then, and we had to take a gain. So same thing with Boston Properties. That's what you want to buy. You buy the highest quality when the whole sector is in the hole. That's how you make money. China in the hole. What did we do? We bought the highest quality thing. So ExxonMobil in the 20s, okay? And the thing just completely doubled and it continued to go up. So anyway, I don't like to dig down second and third tier unless it's a really special situation like Cooper Standard. I just wait for super fat pitches. The whole thing got shellacked like China, and then just buy the highest quality where you say, if this sector is going to remain alive, this will be the winner. And then you can lean into it. You can't lean into, like, what's the point of having 1% positions, and, you know, half of them don't work, and then the other half make 5. Like, just get the best quality so you can put some size into 8 or 10, 12 companies and sleep well at night, like Disney, like Boeing. I don't have to stay up at night thinking about these companies. It's just a time arbitrage. Some are going to double and triple in a year or two. Some are going to take 3 to 5 years, and overbalance on average over the portfolio. It takes them 3 years, and we just rinse and repeat over and over and over. And we get a kicker with our option expression, derivative overlays, and it just works. And that's why you saw all these beautiful people that I acknowledged at the beginning of the call want to be a part of it. And we're very grateful, and we will continue to work nonstop and be productive every day on their behalf, and so on. All right, so here's a guy who's got the Cooper Standard of China. Again, I don't want to deal with these low quality companies in China because half of them are, wind up having crap numbers. And I'm just not going to take country and company risk. This is a train wreck. Forget it. I'm sure the numbers look good. I just don't know if the numbers are correct. Let's just see here. That is new client. Okay, last question, Roy Nakuzi. Love the podcast. Thoughts on the U.S. coal market, specifically ticker AMR. Coal market. So it's up 200% since 2020. And because it's pulled back to 100%, we are now, 200x. Yeah, it's up 200x since 2020. And now it's pulled back to 100x, and we're going to look at it. Okay, I will entertain that. Let's take a look. AMR. So cash flow is coming down after peaking. Revenues are coming down. Margins are coming down. And the stock's up 100x. For me, it's a hard pass. I'll stick with my natural gas, Comstock Resources. Hopefully, I'll run into my quote-unquote partner, Jerry Jones, in early November when I'm at the Cowboys game. So, shake his hand. That would be fun. If I come back with a Jerry Jones picture for the podcast, that would be something else. Anyway, with that said, I want to thank everyone for tuning in. So grateful that you come and join me every week. We'll be back next week. Same time, I think same place. In the meantime, make it a great one. Bye for now.